10 years ago, a person commits to one thing: $500 per month into dividend stocks. Not a windfall, not an inheritance. Just $500 every single month, reinvested. What does that actually look like in year 10? What does the income stream look like? What did it feel like in years 2 and 3 when the account balance was embarrassingly small? And most importantly, what does year 10 tell us about what years 11 through 20 will produce? This is the math of slow wealth. And slow wealth, compounding undisturbed over a decade, produces numbers that most people find genuinely surprising. Let's start at the beginning. Month 1, you invest $500. You buy shares of SHD, the Schwab US Dividend Equity ETF, at its current price. The current yield is approximately 3.5%. Your $500 earns you roughly $1.46 in dividends that first month. You reinvest immediately. Month 1 doesn't feel like anything. You have $500 in an account generating $1.46 per month. This is the moment most people wonder if they're doing something pointless. But the $1.46 is not the point. The point is that the habit is built. The automatic transfer is set. The account exists. Every landmark on this 10-year journey begins with that first month that felt like nothing. Month 12. You've invested $6,000 over the year. Your account, at a moderate total return of 10%, is worth approximately $6,300. You've generated roughly $220 in dividends that you've reinvested. The income from reinvested shares is now slightly higher than it was in month 1. You're now generating about $18 per month in dividends. This is where 80% of investors who start quit. $18 per month. It looks like nothing. It is nothing compared to your rent, your car payment, your grocery bill. The people who understand compounding know what this number becomes. The people who don't see a pointless exercise. Year 3. You've invested $18,000 total. Your account, assuming SHD's historical performance, is worth approximately $22,000. You're now generating roughly $770 per year in dividends, about $64 per month, all of which has been reinvesting into more shares, which are themselves generating more dividends. You've entered the flywheel. The account is no longer just you contributing. The account is also contributing to itself. The number of shares grows with every dividend payment. Each additional share generates its own future income. Understanding exactly how the drip mechanics work makes the flywheel visible. When you enable the dividend reinvestment plan on SHD, every quarterly dividend payment automatically purchases additional fractional shares at whatever the current market price is. No manual action required. In year 1, when the account generates roughly $44 per quarter in dividends, DRIP buys approximately 0.6 to 0.8 shares per quarter, a fraction of a share. It feels almost ceremonial. By year 10, when the quarterly dividend is approximately $892, DRIP is buying 10 to 12 shares per quarter, shares that immediately begin generating their own dividends on the next payment cycle. The rate of acceleration increases over time rather than decreasing. Each share bought by DRIP votes for a larger DRIP purchase next quarter. The engine gets more powerful every 3 months, not less powerful. This is the mechanism most people never fully visualize when they start a dividend portfolio. They imagine linear growth, but DRIP produces acceleration. The curve bends upward. Year 5. $30,000 contributed. Portfolio value, assuming 10% annualized total return, approximately $40,000. Annual dividend income, roughly $1,400 or $117 per month. This is when the math starts to feel real. The portfolio is generating income that covers a small but real bill, maybe your phone, maybe your internet. Your money is beginning to pay for things, and what's notable at year 5 is that the growth on your portfolio has now exceeded your annual contributions. You put in $6,000 per year. The account grew by more than $6,000 in the past 12 months from appreciation and reinvested dividends alone. You are no longer the primary driver of your own wealth building. The money is doing more work than you are. Year 7, $42,000 contributed. Portfolio value, approximately $64,000. Annual dividend income, approximately $2,240 or $186 per month. The portfolio is now generating more in annual dividend income than you're contributing monthly. Let that land. At year 7, the portfolio generates $2,240 per year. You contribute $6,000 per year. But those $2,240 in dividends, reinvested, are buying more shares that will generate their own dividends. You're contributing $6,000, but the investment engine is also contributing $2,240, and that $2,240 grows every year. In a very real sense, you now have a second investor in your portfolio alongside yourself. That second investor is your portfolio. It never misses a contribution, never has a bad month, never decides to take a break. It just compounds. Year 10. $60,000 contributed out of pocket. Portfolio value, at 10% annualized return, approximately $102,000. Annual dividend income, approximately $3,570, or roughly $297 per month. This is the milestone. You've crossed six figures. You've contributed $60,000 of your own money and received $42,000 in portfolio growth on top of it. And you're now generating $297 per month in passive income. Consistently, quarterly or monthly, deposited into your account without any work on your part. The $297 per month at year 10 isn't life-changing on its own. You know that. It's $3,564 per year. But think about what it specifically covers. Your phone and internet bundle, your car insurance, your streaming services, plus your dining out budget for the month. What shifts at this milestone isn't the size of the income, it's the quality of it. You now have a bill that pays itself, not a bill you pay with labor. A bill your portfolio covers while you sleep, and the psychological weight of that first bill that pays itself is disproportionately large compared to the dollar amount. Something changes in your relationship with passive income when it becomes tangible and specific. The next $297 per month feels achievable in a way it never did when you were staring at $1.46. Here's the number that actually matters for the future. You now have $102,000 working for you. At this point, even if you stop investing entirely, the portfolio compounds on its own. At 10% annual return with reinvested dividends, a $102,000 account becomes, year 15, 5 more years, approximately $165,000. Year 30, 20 more years, approximately $265,000. Year 30, 20 more years, approximately $265,000. Year 30, 20 more years, approximately $265,000. The contributions you made in years 1 through 10 are still compounding. They never stop. Every dollar you put in during year 1 has been compounding for a decade by the time you reach year 10. The earliest dollars work the longest, which is why the person who starts at 30 with $500 per month will always outperform the person who starts at 40 with $700 per month, even though the later starter is contributing more. But what if you keep going? What if you maintain the $500 per month into year 20? Year 15, $90,000 contributed total. Portfolio value, approximately $200,000. Annual income, approximately $7,000 or $583 per month. Year 20, $120,000 contributed total. Portfolio value, approximately $380,000. Annual income, approximately $13,300 or $1,108 per month. At year 20, the portfolio is generating over $1,000 per month in passive income, and the total out-of-pocket investment was $120,000. The portfolio did the rest. Now let's talk about what this actually required. Year 1 required discipline when the account looked like nothing. Year 2 and 3 required patience when $64 per month felt insulting. Year 5 was the first moment of feeling like something real was happening. Year 7 was the moment the math started doing some of the work for you. The biggest threat to this trajectory isn't the market, it's behavioral. This is where most people fail, not because they lack discipline, but because market psychology is powerful. Before the behavioral scenarios, a word on what bear markets actually mean for this specific strategy. Most investors dread market downturns. The $500 per month dividend investor should feel differently. If SHD drops 25% in year 4 of the plan, your $500 per month now buys 33% more shares than it did at the prior high. You are accumulating more units of a dividend-generating asset at a discount. When the market recovers, and the US stock market has recovered from every single bear market in its history, those discounted shares appreciate back to fair value while continuing to generate dividends the entire time. The investor who systematically continued contributing through the 2022 calendar year decline bought SHD shares at prices that have since recovered and appreciated further. The investor who paused missed the cheapest buying window of the decade. Bear markets are painful in the short term and mathematically favorable for anyone with a long horizon and the discipline to continue. Scenario 1. The investor stops contributing for 6 months after a bad market stretch in year 4. The S&P 500 dropped 20%, and the account that was worth $28,000 dropped to $22,000. The investor paused contributions to wait for things to stabilize. A completely reasonable sounding decision if you don't understand market cycles. They missed 6 months of buying shares at discounted prices, exactly when the best returns happen historically. That pause costs approximately $40,000 in terminal value at year 20. The psychology is understandable. The math is unforgiving. Scenario 2. The investor withdrew $15,000 in year 7 to help with a home purchase. The account dropped to $49,000. The compounding reset from a lower base. That withdrawal, $15,000 in year 7, costs approximately $70,000 in terminal portfolio value by year 20. This is the cost most people don't see. Money you pull from a compounding account doesn't just lose itself, it loses all the future growth on itself. That $15,000 at 10% annual return over 13 years becomes approximately $45,000. The withdrawal creates a permanent $45,000 deficit. Scenario 3. The investor increased contributions to $750 per month in year 6 after a raise. The terminal portfolio value at year 20 jumps to approximately $520,000, generating $18,200 per year in income. The math rewards consistency and punishes interruption. Modest increases compound into large differences. The single most important variable is not the specific stocks, it's the duration and continuity. One more detail on SXD specifically. The fund holds approximately 100 U.S. dividend stocks screened for dividend growth history, financial health, and yield. The top holdings are typically companies like Coca-Cola, Chevron, Home Depot, and AbbVie, businesses with decades of dividend payment history and pricing power that allows them to raise payouts consistently. Over the last 10 years, SXD's dividend payment has grown at roughly 11% annually. That growth rate, compounding on top of the reinvestment compounding, is why the year 10 number reaches $297 per month, rather than the $100 per month you might estimate by simple math. The fund's own dividend growth does part of the work for you. One more number to leave you with. A person who started this plan in 2014, investing $500 per month in SXG, would have a portfolio today, in 2024, worth approximately $110,000 to $130,000, depending on dividend reinvestment timing and price variations. They contributed $60,000. The market added approximately $50,000 to $70,000 on top. If that person had never started, they'd have $60,000 in a savings account earning 1 to 2%. The compounding difference on a simple, consistent, boring strategy was $50,000 to $70,000, without touching the account, without picking stocks, without timing anything. And the person who started in 2014 lived through 2 bear markets, the 2018 correction and the brutal 2022 decline, without the strategy breaking. The dividends kept arriving. The automatic contributions kept buying. The only way to lose with this strategy is to stop it. Every month you keep it running, the flywheel spins a little faster. What do you do with the income at year 20, when the portfolio is generating $1,108 per month? There's a decision framework worth thinking through now, even if you're years away from it. If you don't need the income, continue reinvesting the full amount and let the compounding run toward $2,000 per month in year 25. If you want to use some income while the portfolio keeps growing, consider a partial reinvestment approach. Reinvest 50% of each dividend payment and take the other 50% as spendable cash. At year 20, that means roughly $550 per month in real income, while the portfolio continues compounding at a slower but still significant rate. The partial reinvestment strategy lets you start living on the portfolio while it's still growing underneath you. And if you ever reach the point where you genuinely don't need the capital growth, if you're in full retirement or have other income sources, you can switch to full distribution mode and take the entire $1,108 per month as cash. The portfolio doesn't care what you do with the dividends. It keeps generating them either way. The choice is entirely yours, which is exactly what financial independence means. Where are you in the timeline? Are you in year 1 staring at $1.46 per month and wondering if it matters? It matters. Are you in year 5 starting to feel the flywheel? Keep it going. Comment and tell me how far in you are. I genuinely want to know where this community is in the journey. Hit like and subscribe. Next week, we're talking about the high-income poverty trap and why earning more might actually be making you poorer.